Hey everyone, welcome back to Corporate Decoder, the place where we dig through the documents that companies don't want you to read too closely. Today, we're looking at a filing from Clean Energy Technologies, and let me tell you, after reading this, I'm not sure their technology is the only thing that needs cleaning up. This is an 8K filing, which is basically a company's way of saying, hey SEC, something important just happened. In this case, it happened on February 28, 2025. The big news is that Clean Energy Technologies made a deal with a company called Mast Hill Fund. Think of Mast Hill as a lender, someone who gives money to companies. In this deal, Clean Energy Technologies sold them something called a junior secured convertible promissory note and some warrants in exchange for money. Let's break down what all that means. A promissory note is basically an IOU, a promise to pay back money. Secured means that if Clean Energy Technologies can't pay back the money, Mast Hill gets some of the company's assets. Junior means that Mast Hill is behind another lender, Nations Interbank, in line to get paid back. So if the company goes bankrupt, Nations Interbank gets paid first and then Mast Hill gets whatever is left, if anything. Convertible means that Mast Hill can turn the IOU into shares of Clean Energy Technologies stock. Warrants are like options. They give Mast Hill the right to buy shares of Clean Energy Technologies stock at a set price, in this case $2.50 per share, within a certain time frame. So for all this, Mast Hill paid Clean Energy Technologies $558,000, but it wasn't quite that simple. Out of that amount, $8,000 went straight to paying Mast Hill's legal fees. Another $50,000 went to Nations Interbank, the senior lender. So after all the deductions, Clean Energy Technologies only got $500,000. What's the catch? Well, the agreement says Clean Energy Technologies has to use the money for specific things like paying Nations Interbank, paying for daily operations and business development. They can't use it to pay back money owed to their own executives or to invest in other companies. There's also a condition about a shareholder meeting. If the stock price drops below $0.50, the company has to hold a special meeting to ask shareholders to approve the issuance of more shares to Mast Hill. This is because there's a limit called the exchange cap on how many shares Mast Hill can get without shareholder approval. The exchange cap is around 9 million shares. The company can't give Mast Hill any more shares until they get their shareholders to agree to it. Now let's talk about the note itself, the IOU. It matures or comes due in a year. It has an interest rate of 10% per year. Here's where it gets interesting. Mast Hill can convert the note into shares of stock. The price they pay for those shares will be the lower of either $2.50 per share or 90% of the lowest average price of the stock in the 5 days before they convert. However, there's a limit. Mast Hill can't convert the note if it would give them ownership of more than 4.99% of Clean Energy Technologies stock. This is likely to avoid triggering certain regulatory requirements. And to sweeten the deal, Mast Hill gets to deduct $1,750 from each conversion to cover their fees. Finally, the warrants. These give Mast Hill the right to buy 310,000 shares of Clean Energy Technologies stock for $2.50 a share for the next 5 years. So basically, the filing tells us that Clean Energy Technologies got some quick cash, but it came at a price. They need to pay it back with interest and might need to give up a chunk of the company if Mast Hill converts the notes and exercises the warrants. Now let's step back and look at what this means for Clean Energy Technologies. This company makes equipment for converting waste heat into electricity and for cleaning natural gas. They're in a tough industry competing with bigger, more established players. They need cash to grow, but this deal with Mast Hill seems pretty expensive. The high interest rate, the potential for dilution, and the restrictions on how they can use the money all raise concerns. On the one hand, this cash infusion could help them expand their operations and win new customers. On the other hand, if they don't execute well, they could end up owing a lot of money to Mast Hill and diluting existing shareholders. This loan is like a double-edged sword. It could help them win or severely cut them. One thing that stood out is the company's reliance on exemptions in the Securities Act. They were able to sell the stocks without having to deal with the headache of registering with the SEC. This can save time and money, but it also means less scrutiny. Overall, this filing paints a picture of a company that's in a tight spot but is trying to make the best of it. They're taking on debt to fuel growth, but they need to be very careful about how they manage that debt. The deal with Mast Hill could be a lifeline, or it could be an anchor. Time will tell. Thanks for watching. If you found this video informative, please subscribe, like, and comment below. What do you think will happen to clean energy technologies? Let me know in the comments.